How is everybody doing? Welcome back to another episode of the Banker Next Door. I am your host, Dr. Joe Berquist. So we're continuing today our discussion of the most recent Treasury report that was issued on April 30th, 2025. And this was issued by the TBAC, which I've always had to look for this, is the Treasury Borrowing Advisory Committee. Treasury Borrowing Advisory Committee, the TBAC. So yesterday, in the 20th installment of the crypto series, I basically covered their comments around stable coins and basically the presentation they put together on stable coins. But today I'm focusing more on just the total Treasury report itself. And I thought I would do something really neat here. I thought I would show everybody a couple of different charts on a number of different aspects of this, and then we'll go back and we'll look at the report itself. So here is the report to the Secretary of the Treasury from the Treasury Borrowing Advisory Committee. But before we get into that, I want to show everybody a couple of things here. So again, and most of these charts are from the FRED database. So FRED is the St. Louis Federal Reserve Bank, one of my favorite data sources. So here is this is federal government treasury operating cash and asset levels. So this is basically the cash in the cash account, if you will, at the Treasury. You can see here in basically the third quarter of 2020, we were sitting at about $1.7 trillion in cash, came all the way down here to 215 billion. And then got back up to the second quarter of 2022, got back up to about 782 billion, and then down here to 177 billion, and then got up the fourth quarter of 2023, about 768 billion, and then topped up here at the third quarter of 2024 at 885 billion, and is now currently sitting at what has your fourth quarter of 2024 at 721 billion. But we are actually much lower than that now. I think we're down to more like maybe like just above like 500 billion. But the point is, it's low. It's not where it needs to be. Think about it like this: like you're running your monthly bills, and you need $10,000 to come in the door because you've got $6,500 of monthly bills, and you like to have a little left over there for savings, and maybe you're saving to buy a car or something like that. So you like to have a little something left over. So right now, think about it like this: like we've got like 500 billion sitting there, but we got bills coming due that are worth more like 800 billion. And there's no money to be saved. There's no money for the U.S. to put aside for other things at the moment. So think about it kind of like that. It's not that detrimental yet, but we'll get into our discussions of the debt ceiling and what all that could mean in a few minutes. Then so this is overnight reverse repurchase agreements, otherwise known as repo. We could see here kind of a similar story in the repo market. So if we go back to December 30th of 2022, we're sitting at $2.5 trillion in the repo market, and now that has come all the way down here to basically 142 billion as of Friday, May 9th. So as of Friday, we're sitting here at 142 billion in the repo market. Now, you might point out that, hey, prior to March 26, 2021, I mean, there really wasn't a whole lot going on here in the repo market over here, and that this was a little abnormal. But I want you guys again to think of this as like the repo market is critical to the liquidity of the overall market, and getting down to this low of a point is not a good thing overall. Now, here's another chart. So this is basically the value of the U.S. dollar in blue. And then you have the market yield on U.S. Treasuries, basically the 10-year T-bill, if you will, in red. And I just point this out to you here because so you can see the 10-year T-bill here going up, whereas the dollar is weakening and coming down. So basically, I just want to make the point of the dollar is weakening versus the 10-year Treasury. They're going in basically opposite directions right now. So just want to point that out. And then we have here. So this is the M2 money supply. So you can see here that basically the money supply is going straight up. So this is in billions of dollars. So basically you got $21.7 $1 billion of money, cash, rolling around in the system right now. And that's gone up since basically April of last year. We've gone from, 20.9 up to, 21.7 billion. So adding a little bit of money to the money supply here. If we go back over 5 years, you can see this is kind of, shot up dramatically here. Obviously, COVID, and then coming back down a little bit, but still staying relatively elevated. Now we look at the velocity of M2 money stock. And I think and velocity is much more important than the actual supply of money itself. And we can see here that, since basically we hit a high in 1997, and that velocity of the M2 money supply has just been going down. And then during COVID, it basically fell off a cliff. Now that velocity has come back up, but now in the last few months, though, we're seeing that velocity starting to kind of peter out again. And then here, I thought this was just interesting. So this is basically the global bond market. So global markets exceed 1 quadrillion, not even a trillion. This is a global market, $1 quadrillion in 2023. And you can see that how is the global equity markets, how is this made up? Basically you got rates, which is the biggest one. And then you got credit, you got equities, you got FX, which is currencies, alternatives, digital assets, commodities, and then MM. And then we go down here. I wanted to show global rates, but here's one of the big ones I wanted to point out. Credit markets have tripled in size since 2018. So despite the issuance slowdown in securitization issuance, the growth in credit markets, i.e. your bond market, was plus 5.7% year over year in 2023, driven by corporate bonds and syndicated loan segments. So credit market dynamics. So, look at that. Look at this 2018, and it's 3 times bigger. Corporate bonds, credit derivatives, structured finance, syndicated loans. That is pretty incredible. And again, this chart here only goes up to 2023. So this is basically a 5-year period. Credit markets basically tripled in size. 50% of credit markets are corporate bonds. And then I think that was all I really wanted to show you in here. But yeah, so I just wanted to give everybody a sense of how big the global credit markets are. It's pretty fascinating, the size of these markets. And the U.S. bond market is a huge market. And so again, what's interesting about that is people put so much emphasis on what's going on in the stock market, yet the bond market is just as equally as important, if not more so, in times like this. And that's why we're reviewing this report here. So let's get into this for a few minutes here. So since the TBAC last met in early February, changes in U.S. government policy and shifting economic projections, most notably higher than expected tariff rates, have led to significant movements across global asset markets. And then they give you yields on 2-year, 10-year, 30-year, S&P 500, the U.S. dollar, value of the U.S. dollar. And then it gets into, what's going on, the global economic outlook. They talk about, GDP, inflation. I want to kind of skip through some of that. And I want to get down here to projected funding needs. So in addition to economic outlook, is especially challenging ahead of a visible end state on international trade negotiations. After reducing policy rates by 1 percentage point in the second half of 2024, the Federal Open Markets Committee, FOMC, paused rate cuts in January and March and is signaling that pause will continue at least through May. Yes, it did. Given upside risks to inflation, downside risks to the labor market, and continued policy uncertainty, most Federal Reserve officials have indicated that they prefer to wait for more clarity on policy and the economy before adjusting policy rates. Interest rate markets are currently pricing about 90 basis points of rate cuts this year. This indicates that relative to the Federal Reserve dot plot median for 2 rate cuts this year, market participants see risks as skewed to scenarios where the Federal Reserve would cut more deeply. The implication being that should the labor market deteriorate, Federal Reserve officials would be prepared to look through tariff-related inflation and reduce policy rates to support the labor market. So interesting. While most attention was centered on trade policy, Treasury and investors are also monitoring fiscal developments. With a compromise budget resolution passed by the House and the Senate, interest rate markets will be sensitive to deficit implications of the details of the fiscal package and look forward to debt limit resolution. Assumptions about future tariff revenue also affect projections for future deficits and Treasury supply. Market participants are questioning a credible path to a more balanced deficit outlook over the medium term, contributing to the rise in term premium. Heightened economic uncertainty has hampered risk taking and warranted increased return for risk warehousing. More significant than the net market moves, however, has been the scale of intraday volatility. So, yeah, they talk about some volatility in the market. More broadly, the highly unusual simultaneous decline in valuations for U.S. equities, Treasuries, and the U.S. dollar drove some investors to question the safe haven status of U.S. Treasuries. Yeah, but again, I think a lot of this was like a knee-jerk reaction because we've seen basically a lot of this come back here, even in the last 2 weeks. But it talks about some of the contributing factors, uncertainty about the U.S. economic fiscal outlook, fears of long-term investor selling of U.S. Treasuries and U.S. assets, deleveraging in response to the VAR shock, views that an adjustment of global trade balances would lead to lower demand for U.S. assets, unpredictability of announcements and tariff updates constraining risk capacity, concerns about any threat to the independence of the Federal Reserve. Oh, heaven forbid we should question its independence. Any one of these factors is significant enough to disrupt risk transfer in markets, and the U.S. Treasury market was no exception. But then, like I said, we're gonna scroll down here a little bit. While the U.S. Treasury market functioned well through the extreme volatility and market functioning has largely returned to normal, these concerns remain a contributing factor in investor risk decisions. The committee feels these concerns are unlikely to abate given ongoing tariff negotiations and elevated economic uncertainty. Additionally, the committee feels there is an incremental risk premium in the U.S. Treasury market now due to unusually high headline risk, which creates incremental cost to the taxpayer and impacts market participants' confidence in owning and intermediating U.S. Treasuries. Treasury's buyback program remains well received by the market through this period. In keeping with its objectives to support liquidity and cash management, the committee felt there is scope to continue to evolve the program in line with these stated goals. However, the committee felt it important that broader metrics such as WAM still be managed through Treasury's issuance decisions. In light of this backdrop, the committee reviewed Treasury's MAP 2025 quarterly refunding presentation. Okay, and then it kind of goes into some of that. The committee's first charge focused on the debt limit. Now, this is really important. With the discussion on the conclusions of the December 2024 GAO report, that's the Government Accountability Office, the GAO report, the committee felt strongly that in practice, the debt limit does very little to constrain spending, so the benefit of it is unclear. On the contrary, the committee highlighted many known negative impacts of the current debt limit process, including increased volatility in TGA balances, reserves, and T-bill issuance, increased debt servicing cost, negative impact on the U.S. credit rating, negative impact on U.S. reserve status, and possible impact on UST demand, increased risk of technical default, and waste of resources in the public and private sectors. So the GAO report lays out 3 options to improve the process. Number 1, linking the debt limit to the budget process. Number 2, providing the administration with the authority to increase the limit subject to congressional motion of disapproval. And number 3, abolishing the debt limit. Now, I'm on board with number 3. I think we just abolish the debt limit and get rid of it. But I think there's a slim chance of that happening because the reality is both sides love the debt limit, and they both love when Republicans are in power, they love, Democrats love to hold it over their head. Then when Democrats are in power, the opposite is true. Republicans love to hold it. So both party loves it as a mechanism to hold it over the other's head when the other is not in power. So I think there is very little hope of abolishing the debt limit and getting rid of it, even though the common sense and even all these reports that we have would dictate that that is the right economic move and would be the right thing to do for our economy and the country as a whole. But like I said, because of politics, I don't see that happening. I think maybe the best case scenario is maybe number one, maybe linking the debt limit to the budget process. That may prove to be the best thing. So, but let's continue on here. So while the committee uniformly felt that the debt limit provides no constraint on spending and felt this was largely understood by most market participants, there was some acknowledgement that an abolishment of the debt limit could raise perception questions about future spending. Investors could be more sensitive to those questions in the current market environment. However, as the debt limit provides no practical limitation to spending, but does introduce meaningful known risks, the committee concluded that the best option was eliminating the debt limit altogether. The committee felt market perception risk around fiscal responsibility could be managed in other ways, and eliminating the current challenges and, most importantly, the risk of an inadvertent technical default would far outweigh any concerns. This is consistent with the committee's longstanding feedback and letters in previous debt limit episodes. The long-run benefits of reducing market disruption around debt limit episodes would reduce risks to the financial system and likely decrease costs to the taxpayer. Now they get into the second charge, focus on stable coins. If you want to hear that one, go see yesterday's crypto episode that I did. I covered all that, so we're not going to go into all that. Then they get into terms of issuance. The committee recommended keeping nominal coupon sizes unchanged and that the 5-year and 10-year TIPS be increased by $1 billion each. The committee briefly discussed the current demand dynamics for TIPS, especially in light of tariff-driven uncertainty and inflation. As the debt stock continues to grow, the committee felt a review of percentage share-based guidance could be appropriate. And while the committee recommended no change to nominal auction sizes in the next several quarters, members were mixed on the value of the forward guidance language. Some members preferred dropping the language altogether, while others felt a shift in the language might be received poorly in light of the meaningful increase in uncertainty around tariffs and the economic outlook. Universally, the committee felt that any shift in language should not be read to indicate an expected near-term increase in nominal coupon auction sizes, consistent with the TBAC recommended financing tables and Treasury stated objective to be regular and predictable. Lastly, away from economic events, the risk that debt limit constraints could hamper the efficient funding of the government at the lowest possible cost to the taxpayer remains a primary concern of the committee and the market. These episodes can cause significant economic uncertainty, affect financial markets, and impact U.S. credit ratings, as noted in letters written both as part of the quarterly refunding process, but also independently in 2011, 2016, 2021, and 2023. Lack of resolution of the debt limit runs the risk of undermining the foundation of the U.S. Treasury market. So, yes, so there you have it. And again, this is why I go back to this chart of the basically the Treasury operating cash in the Treasury account. You're getting ready to hit this debt limit in August, and this could cause a whole lot of problems here the second half of the year. So we shall see what goes on. But again, great report, great information, really interesting. Obviously, they have some real concerns around the debt limit, but again, buyback program seems to be working well at the moment. Treasury issuance seems to be okay at the moment. But again, they're fearful of some of these things. Just the unpredictability around tariffs. How could, any kind of threat to the independence of the Fed, how that could affect the market, and then the overall U.S. economy and the fiscal outlook, but overall, things are remaining steady at the moment, and we continue to proceed ahead, and we shall see how things proceed from there. So, but anyway, I hope people found this interesting. I thought that this was really good information and gave us a real insight as to where the Treasury is right now and what they are thinking. So, and if anybody wants to look at this, there is a link to this in the description down below. And I hope, again, people will check it out. But with that being said, I will wrap up by saying if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. Make sure to check out some of the other content on the channel. And remember, BND Live, the BND Strategy Room, the live stream show of the channel is every Saturday night at 8 o'clock. Please be sure to check that out, as I always love having everybody on at that time. Have a great day out there, and I will see everyone again real soon. Thanks a lot.